Hi, folks, and welcome back to Money and Politics. It is December the 15th, 10 days to Christmas. And if you haven't done any Christmas shopping, which I have not, so I have to get that done. So we had some news today. The Federal Reserve, halfway through the day, announced what they were going to do. They said they were going to be raising interest rates, but they had a couple more months of easing. So they're probably going to raise rates after March. And reading from my own Twitter here, it says the Fed projects there'll be 3 rate hikes in 2022, 3 more hikes in 2023, and another 2 in 2024. Those are not set in stone. Those can be done away with if they think they've vanquished the inflation bug. And each of those increases will probably be eased into, I presume, at this point, based upon what they did in the past, is that they will probably raise rates 1/4 of a point each time. So that would be 3/4 of a point if they hold up to what they predicted, 3/4 of a point throughout 2022, another 3/4 of a point, so that's 1.5 points by the time we get to the end of 2023, and another 2, which would be 2 full percentage points by the time we get to the end of 2024. That's 3 years away. 2 percentage points from a very low rate is not a big thing, and it would be malpractice if they didn't do that. So while I'm typically not in favor of raising rates, in this case I am, and I think you can see the market was as well. We had a big turnaround, and let's just start with Humble, and you can see the down dip in the middle of the day, and then we got a bit of a rise, and then a bit of a sell-off shortly thereafter. Humble was kind of the outlier as far as the reaction. We had FNGU. This is the exchange traded note. Again, this is 1 day, so you go and you can see how in the middle of the day we went up then sharply to be up over 5%. We got a bit of a bounce back on Zynex, which had been down to $9 and so, which was where we began the day, about 935, which is also the 52-week low. But it came back to, as you can see, 10, so up 4.7%. So a nice turnaround from all of those. And then we got, here's you really see it in mode. These are all one-day charts going down. And then bang, bouncing back. So it was down to what, $64 or so, just under 64, and came back up 67.40, up 3.2%, up slightly to 68 after hours. I remain on this a big fan, and I would advise, if you are so inclined, you make the decisions. But if you're so inclined, I would buy more. I'm going to keep buying more myself incrementally as we go along. Now, I wanted to, that's the big news on interest rates. And I was happy with how the market reacted to it. I didn't know if they'd be up or down. And that's why I had the other day, I'd mentioned the SQQQ, which is the opposite of the TQQ. The SQQ goes up if the market goes down. It's a 3-time short on the NASDAQ market. So yesterday morning, I bought some. I had toyed about doing it the day before on Monday. On Monday, it was about 618 or so. I didn't buy it. I bought it at 646. It ended up yesterday at one point, it was up, I think, about 8%. And then after the market, right as I got a news flash about the interest rate So right after that came out and I saw which way the wind was blowing on the markets, I jumped out and sold my position out. The SQQ is not something that I would advise you don't want to hold that long term. The overall market is always going to be up, as I've shown you before, the S&P 500 chart of 50 years. It'll go down periodically, but overall you're going to be up. So you don't want to hold on to a short on the market long term. But it is, as I only mention it, that's how I played the interest rate. I took out a short position. I was up slightly. I didn't really make money on it. I got out just about where I got into it. I may have made a very minor profit, but to me it was an insurance policy. If the market had collapsed, I would have had some insurance against my position on the NASDAQ with the TQQ, which is the 3-time. Now, you know how Facebook, and I'm on Facebook, how Facebook brings up memories from the past, and I've long to encourage people to invest, would be posting about the market on Facebook. So this came up today, this is from 5 years ago. This is where the markets closed on December the 15th of 2016. And I thought this would be kind of interesting to compare 5 years to the day. Now, the markets were up strongly right after Trump got elected in 2016. So this was December the 15th. Trump had been elected on, I think it was like November 4 of 2016. So this is about 6 weeks or so after his election. And the markets had been going up very strongly after his election. So let's take a look. We got the Dow there. What has the Dow done over the last 5 years? It was 19,950. It's now 35,927. That's a gain of 80% in 5 years. You can see there the S&P back in 2016 was 2272. The S&P now is 4709, up 107%. And we have the NASDAQ 5485. The NASDAQ now is 15,565. That's a gain over the last 5 years of 183%. And the reason I want to bring this to your attention is that, folks, while we talk about some individual stocks, don't forget, and I have preached this, that the indexes, buying the index, in other words, buying the entire S&P, buying the entire NASDAQ, or buying the entire Dow, are great ways to invest. You don't have the risk that you have when you buy one company. And the S&P and the NASDAQ especially, I prefer the leveraged versions. Now, I went on the, the thing I like so much, I went on the Yahoo Finance. And on Yahoo Finance, you can look for good mutual funds. I am not a fan of mutual funds, but you can look on good mutual funds. So I did a little research here today, and this is the list of some of the top mutual funds. And I'm kind of covering it up. Let me take myself. If you go down and say, well, what was the number one for the year? And as you go down, you're going to see here we have this one at V as in Victor, WELX. And that's up 16.75% on the year. Well, what I want to know is, would that have been a good buy? So let's do what we have done before. We'll put in on the S&P 5, on the Yahoo rather, I'm sorry, I'm thinking of different things. Let me hit this button. We bring this up, and here's the Vanguard Wellington, and Vanguard's a good company, Vanguard Wellington Fund. It has one thing I like. It has a very low, especially for a mutual fund, expense ratio of 0.24%. Some of these mutual funds are 3% a year. So this is 0.24%. Also notice that it pays a dividend of 1.67% at this time. But let's see how it does. We want to do a comparison. Would this have been, compared to buying the indexes, would this have been a good thing to have, this mutual fund? And as I remind you, as I just showed you, I picked it from a list. These are all 5-star. That's what I look for. What are the 5-star top-rated funds? And then I picked the one that had the highest return year to date. And this is what it is. So let's go to full screen. And come on, baby. And bring it up. And see what kind of return we have. And this is, let me get out of here for a minute with my camera shot. So here we have, this is, let's do a 1 year. And then let's go. That's the light blue. You know, I think I might change that just so we can see it a bit more. Let's make it kind of a dark purple there. Now let's compare it. How did it do relative to the S&P 500? I'm going to make that stand out. So the red is the S&P 500. This is 1 year. So here we got year to date, the fund I just showed you, which is in blue, and there now it says 15%, as compared to the S&P, which was up 26%. That's a hell of a rate of return, by the way, for the S&P, for that to be up that high. I should make myself smaller. Move it. Let's compare this to 2 years. Did it change? Nope. The gap is even bigger. 47% for the S&P, and over 5 years, there you go. Quite a difference. And again, you can see the dip that we have here. So even the mutual fund also had the dip. Now, I like and I know I'm repeating for some of you, but I also get people who have not looked before. So I look like the leverage version. So while in red we have the S&P that is not the leverage, let's have the leverage version. And we'll have the leverage version be in green. This is 3 times the S&P. And boom, there's the difference. So look at the difference, folks. This is the U-Pro. U-P-R-O is 3 times the S&P over 5 years, and that's us up 429.5%. Let's say 430% to round up, compared to 27% for the mutual fund that was supposed to be so good. And if we add then, let's add the NASDAQ itself, not leveraged, in blue, you can see how the NASDAQ beat in red, the S&P, which is not surprising. But again, we like the TQQQ. And I've told you about this before. It's gone gangbusters. And there you go. This is over 5 years, up 1,420%. So look at this for a moment, folks. The great mutual fund, the 5-star, which got the best, this year. But here you got, still, it's coming in last place down below. Comes in below the NASDAQ, comes in below the S&P. And by the way, this is something that doesn't happen very often. In that light blue is the NASDAQ, and that's below the S&P. Normally, the S&P will be below the NASDAQ. So the NASDAQ, the tech stocks, did not, they're up about 20%, which is very respectable. It's unusual that they didn't beat the S&P. But look at the leverage versions, and you have the leverage version of the S&P in green, and that's up 87%, and the leverage version of the TQQ, this is again for the year to date, and that's up 76%. So you can have your money growing at 15%, or you can have your money growing at somewhere between 76 and 87%. That's just for the year. If we go out to 2 years, there you go. As I expect, the TQQ over a longer period of time is going to outperform all of those. So it's interesting that we have this comparison. And again, to bring up this from 5 years ago, folks, and people back then, were afraid of what's Trump going to do. We had, what's his name, the economist Paul Krugman predict that the markets would collapse after Trump was elected back then and would never recover. In fact, they just loved it and skyrocketed. And Paul Krugman, personally, I think he's a knucklehead, but he won the Nobel Prize, okay? To my knowledge, he's never been right about hardly anything, and especially this, that the markets would go down and never recover, and instead, that nothing like that was true. So as we go forward, as we, I hit the wrong button. As we go forward, we always are going to have doubting Thomases about where the market's going and the challenges that we face. Right now, we have a big transition going. We have, obviously, as you know, blockchain. We have cryptocurrencies. And that is the talk of Wall Street, but also what's going on in the Senate. Yesterday I covered, and I have it on my other channel, and I put the link in yesterday on my YouTube Money and Politics video. I put the link into the full hearing if you wanted to hear that. The Senate Banking Committee chairman said that he wants regulations on the cryptocurrencies. I was actually looking for his bite, and it's no longer there on the page I had lined up. But anyway, there's going to be some regulation coming up on these cryptocurrencies. We got to expect that. But here's a small 30-second clip from yesterday. I thought this was kind of a nice, short and sweet of one of the witnesses, who's a sharp guy, talking about blockchain. And basically what he's saying is some of the concerns about blockchain of today are not necessarily going to be the concerns going forward, because we have such revolutionary change and so many dynamic changes being made to the blockchain itself, that he compared it to how fast the internet itself changed from dial-up to what we later went to on the internet. Here's a listen.
Quick version of this is early blockchains are a little bit akin to dial-up internet. And the argument to ban the stablecoin innovation because the current experience on certain early blockchains may be a little slower, a little cost prohibitive, ignores the fact that the innovation isn't standing still. They're late generation blockchains, third generation blockchains that are approaching transaction throughput akin to major credit card networks and approaching cost structures on pennies on the dollar for value transfer.
So we have a lot to be looking forward to in the next 5 years. Just as we saw the explosive growth, I hope that we're going to continue to have some explosive growth. But there's going to be challenges, folks, and you got to be prepared for it, and I've said that to you. I think you can have growth and security. I think that you don't have to go and lock yourself into these, into these mutual funds that have your money growing in the slow lane. I mean, again, I went and searched for the 5-star, and I just showed you the differences there. So I've showed you how you can trounce these mutual funds and these 5-star funds and how you can grow your money much faster if you're investing in the right things. And those leveraged indexes can go down 3 times faster. That's the way they're designed. They'll go up 3 times faster. They can go down three times faster. But when you're investing in them, you have to be taking the long-term view that you're going to be hanging in there and growing your money, and that you're willing to put up with the ups and downs of the market, which are going to be amplified by these leveraged indexes. Now, the so-called, professionals on Wall Street say you're not supposed to be investing in these long-term. I disagree, but I add the caveat that I just added. And the other thing I would say is, if we look at this and we look at, let's say, a 2-year chart right here. Well, we got the 5-year chart. Let's go to the 2-year. That when we had the shutdown back in the spring of 2020, back here, you can see how far off these indexes fell, but look how they came bouncing back. And I can't close. I wish I could close in here. Here's the one thing where the mutual fund didn't go down as much, and that's where the people that advise mutual funds, back here in like March of 2020, that's when the COVID came out and the markets just fell like a rock. Yes, these leveraged indexes fell sharply. The gold and the, let's see, the green is the UPRO and the gold is the TQQ, and you can see how much they went down. And if you look, then yes, the purple, if I can get that to stand out here, the purple didn't go down quite as much, but look what it did. It never really recovered much. It just kind of crept along with this incremental growth, whereas you can see how in 2 years, the NASDAQ, the leveraged version of the NASDAQ, the leveraged version of the S&P shot up. And over 5 years, you can see the dramatic difference here in how those leveraged versions came bouncing back. So the greatest thing when the market sells off, this is where you want to have, I think, this is me, you got to make the decision. But when the market does sell off, and if we get a sharp downturn, that's where you want to have some cash. That's where, after it sells off sharply, go in and buy some of the TQQQ and buy some of the UPRO. You could also try buying the UDOW. U is in Union, DOW. My preference is the T is in Thomas, TQQQ, 3 Qs, or the U's in Union, PRO, UPRO, which is the S&P 500. So that's where we are, folks. Interesting day. We survived the Fed chairman saying that they're going to be raising interest rates. The sky didn't fall, and the market actually went up, and I'm proud of how the market handled itself. I'll say goodbye. Went long today, but I think we had some good information I wanted to share with you on this day. So for now, see you later. Oh, I meant to say, you may have noticed I tweeted today that I got the stats from, I don't know if I still have it queued up here. I got the stats from YouTube, and it said in the first year, I mean, this is my first year, ending up the first year. My first video was January 25 of this year. And YouTube sent me stats yesterday saying that in 2021, from January 25 until now, I had 5,200,000 minutes of view time watched, with over 692,000 different views. If you take that 5.2 million minutes watched, divide it by 60, that's 87,000 hours, just about 87,000 hours. So I wanted to thank you so much for all of you who have watched, commented, and subscribed. If you haven't subscribed, I hope you will. And you can see just in the last couple of days, as I showed you the clip from the Senate hearing yesterday on blockchain and cryptocurrencies, and some of the interviews I've done with some regulators and some of the other CEOs. We'll be expanding that, I anticipate, going forward. So I hope you'll hang with us, watch often, and comment often. In the meantime, I'll let you go. Thanks as always, folks, and we'll see you hopefully tomorrow.